Welcome to today's Explainer. We're jumping right into a super focused company analysis of WEBSOL Energy System, specifically looking at their absolute landmark FY26 earnings call. If you follow the renewable energy sector, you already know that growth is the name of the game. But honestly, it's how a company manages that growth that truly separates the winners from the rest of the pack. So today, we're going to unpack WEBSOL's strategy using a really simple but powerful framework. We're calling it the engine, the fuel, and the destination. We'll look at their operational growth engine, the financial fuel that's powering it, and the ultimate destination of their long-term vision. Okay, so here's our quick roadmap for this explainer. First, we'll hit those record-breaking FY26 financials. Second, we'll look at upgrading the growth engine. Third, we'll dive into their CapEx strategy and capital discipline. And finally, number 4, their future vision and backward integration. All right, let's get right into Section 1, record-breaking FY26 financials, which is truly a historic milestone for them. So during the call, management, led by Managing Director Sohan Lal Agarwal, made it crystal clear that the business is fundamentally stronger operationally, financially, and strategically than it was just a year ago. And honestly, nothing proves that quite like crossing the massive INR 1,000 crore revenue threshold. That is literally the highest in company history. When you're doing any serious company analysis, crossing a 1,000 crore mark isn't just a rounding error, right? It's a massive psychological and operational barrier that proves they're actually successfully scaling up their capacity and, more importantly, finding the market demand to absorb it. And here's the best part. They didn't just grow top-line revenue. They successfully converted it straight to the bottom line. WEBSOL posted their highest ever profit after tax, surpassing INR 300 crores, and that was right alongside reporting exceptionally strong operating cash flows. Now, for the financial analysis nerds out there, in a super capital-heavy industry like solar manufacturing, generating strong operating cash flow alongside record PAT is exactly what you want to see. It means the core business isn't just growing, it's highly lucrative and fundamentally sound. Moving right along to Section 2, upgrading the growth engine, operations, and expansion. Okay, so now that we've seen the financial output, you're probably wondering, how is WEBSOL physically building this growth? Well, it all comes down to tech upgrades, specifically transitioning to TOPCN technology. For those of you tracking the solar tech curve, TOPCN is a highly advanced solar cell technology that basically just enables much greater energy conversion efficiency. WEBSOL's management highlighted that they're currently upgrading one of their existing cell lines to TOPCN, and they are targeting a cell efficiency of more than 24.5%. Why does that matter? Because it positions them firmly at the higher end of the efficiency curve. And in today's market, that is exactly where premium pricing and high demand sit. To put this into perspective, by implementing these upgrades, they are taking their old base of 1.2 gigawatts of mono-PERC cell capacity, and they're expanding their total cell capacity to 1.35 gigawatts. So they are essentially squeezing more higher quality output directly from their existing footprint. It's a really smart, direct acceleration of their growth trajectory. But, they aren't stopping at just the cells. WEBSOL's Chief Technical Officer, Sriram Vazanti, addressed their module manufacturing line during the call as well. That line currently sits at 550 megawatts of mono-PERC, and she confirmed that it can also be easily upgraded to match these new TOPCon advancements. We're talking about not needing a massive overhaul here, just modifying some kits and operating equipment. This shows some incredible foresight on their part. They built that 550 megawatt line with future adaptability already baked in. Let's shift gears to Section 3. CapEx strategy and capital discipline. This is the fuel for the whole operation. Look, aggressive expansion is great and all, but how is management actually funding this CapEx without losing their financial footing? This is absolutely crucial. MD Sohan Lal Agarwal emphasized that WEBSOL has raised absolutely zero external equity funds for their Phase 2 expansion. Zero. Let that sink in for a second. In an industry that is frankly notorious for constant equity dilution just to fund CapEx, WEBSOL is relying entirely on their generated surplus cash from operations while strategically utilizing debt. As Agarwal noted, in this business, it's not just about expansion, it's about how disciplined you are with your capital. And this intense focus on capital discipline was really echoed by Executive Director Sanjana Khaitan. She stated, "The idea is to manage the debt level prudently, which is what will be our interest area going forward." She was quick to reassure investors that yes, while they will be raising some debt to support this really quick expansion, they already have the surplus cash to cover their immediate needs, and their internal projections show no concerns whatsoever. What's genuinely fascinating about this whole CapEx strategy is this concept of financial agility. In the fast-moving renewable sector, agility is literally everything. WEBSOL's management made it a huge point to say that they are highly conscious of this. By funding their upgrades through internally generated cash and really prudent debt, rather than massive, sweeping equity dilution. They're keeping their balance sheet nimble. They are quite literally powering tomorrow's energy while retaining the financial flexibility to pivot whenever the market demands it. And finally, Section 4, Future Vision and Backward Integration. Let's look at the destination. Okay, we know the engine is upgraded and the fuel is secured, but where exactly is WEBSOL heading in the long term? The answer is full value chain security. Right now, they excel at step one, right? Cell and module manufacturing. But management revealed that their key interest area moving forward is backward integration. They want to move into step 2, wafer production, and step 3, ingot production. By moving backwards up the supply chain like this, they insulate themselves from raw material price shocks. They are basically securing their own destiny. Plus, they're looking at some really smart adjacent diversification. Now, their core focus absolutely remains getting that fully integrated solar production locked down for sure. But they are actively exploring battery energy storage systems, or BESS. They smartly view BESS not as some wild, out-of-left-field pivot, but as a highly logical ancillary product for their already existing module customer base. It's a rapidly growing space, and they fully intend to capitalize on the relationships they've already built. To truly understand why this fully integrated, slightly diversified approach matters, you have to zoom out and look at the macro picture. Management highlighted the staggering figure on the call. The projected industry demand for solar just in FY26 is 150 gigawatts. 150 gigawatts. And the trend is still moving aggressively upward. WEBSOL is operating in an absolutely massive, structurally growing market. Which leaves us with one final big question to consider today. With 150 gigawatts of industry demand looming right now, how much of that value chain will WEBSOL ultimately capture? Think about it. They have the record profits, they are deploying the absolute latest TOPCON technology, they have extreme capital discipline, and they're moving toward full backward integration. As you execute your own financial analysis on WEBSOL's future potential, their ability to execute this ambitious growth roadmap while maintaining that crucial financial agility is going to be the key metric to watch. Thanks so much for joining us to break down this explainer, and as always, keep learning.